All right, Jake. So I want you to take us back before, real estate and capital raising and commercial debt and all the fun things that you're involved in right now. Who is Jake Clopton?
Appreciate it. Good question. So before I started this company like 14 years ago, I actually traded interbank hedging product futures, and that's the really complicated way of saying I traded futures contracts that people use to hedge interest rate risk for LIBOR and Fed funds and 10-year treasury, stuff like that. So that's kind of my like banking background, I guess. And I was doing that before the 2009-ish era, right? And we all know what happened then, right? Financial crisis, interest rates went to zero, didn't move for a really long time, right? And as a trader, you need things to move around to make money. And I was like, well, all right, I got to find something else to do, right? So, at the time, I'd watched kind of what happened in the residential market, right? With the paper and debt that traded hands, and a lot of the similar things were going to be happening in the commercial space, but also there was just a real lack of capital, right? So there was this vacuum in the market of people being able to source and access capital, and my idea was to start a business that sourced and accessed capital for commercial real estate property owners and investors, stuff like that. So I didn't have any background in real estate at all. Like, let's throw that on the table. I had the idea of finding capital for people, and I just started making phone calls. So I just sat around doing cold calls, worked the phones to banks, private equity groups, family offices, and did that for months and months and months. And it was so illiquid at the time. We would find somebody that was lending, and we'd put it out there, and someone would come to it, right? And that over time, has turned into 14 years of commercial debt brokering. But now we're like in the $1 to $100 million space, and then we also do a lot of like more sophisticated, higher capital stack stuff like joint venture equity and pref equity and dollar construction. So, it very quickly turned into what we do today because I really enjoy it. And I think that's why it happened and took off, right? If I didn't like it, it wouldn't have happened. But yeah, so that's where we started. It was humble beginnings, but hopefully.
Well, I want to kind of go back to the humble beginnings a little bit, because to jump from the investment banking and everything in trading at a time where everyone is so illiquid, and then to just think about real estate. I mean, what was it about raising capital for real estate acquisition specifically that kind of got your juices flowing and caused you to think, man, this is a niche that we really can capitalize on?
Pun intended, I guess. It was the concept of there was a crisis. And how do you take advantage, or how do you find opportunity in a crisis, right? And that was, to me, the most value I could add was finding the thing that everybody needed. I mean, at the time, right, it was a banking crisis, and everybody, and like all these people had left the industry, had left the commercial real estate industry, lending industry. So there was not only a lack of people actually even doing it, but there was a lack of, people lending, right? And there was a lack of people that were even looking to do loans because they had to move over to other industries. So it's kind of similar to what I had told like a friend of mine, when the pandemic happened. He was like, oh man, he was in the restaurant industry and he was working as manager for somebody else. He was like, oh man, this is the worst time to be in a century. And I was like, honestly, man, it's probably the greatest time in history, if you can time it right, to start a restaurant or a bar, because everybody else's legacy has been decimated. If you roll in, you're going to be one of the only games in town. You're starting fresh. So that sort of concept is the same thing that I was trying to do back then. It makes me think
about Warren Buffett and the whole concept around when everyone's scared, be excited, and when everyone's excited, be scared. Right. Running in versus running out. We've heard the buffalo analogy, all these things. And that's exactly what it is. You saw opportunity in this crisis to fill a void where a lot of people couldn't. But with no background in this type of venture, I mean, you must have been a little bit scared jumping on the phones, or were you? What was the mindset with some of those initial conversations when you pick up the phone and you start trying to raise this money? What did that look like?
Yeah, I mean, I had, I have a background in finance and economics, right? I don't really have a background in real estate. The cold calling concept, I think a lot of people are intimidating by just making a cold call. That kind of burns off after you've done like 100 of them, and it's a skill you have to learn, right? And the way I kind of look at like all this stuff is like, it's not rocket science. Like we all know real estate isn't rocket science, and commercial lending isn't really rocket science either. What's the most valuable in real estate and pretty much everything? It's your network, right? And my concept was do the cold calls. I can learn the terminology pretty quickly, right? And the concepts, but really build up the network, because I honestly, like, if you build up your network and what you're trying to do to a decent size, you're at least going to get some sort of business done over time. And that was really the concept, right? Make phone calls, make the connections, the relationships, build up the network, and then form the business kind of around there.
Okay. So I want to get into some of those things because, as I told you off air, the majority of our listeners play more in the residential world, and some of these commercial concepts are a little bit newer to them. And the reason why I have guests like you on is because I really want agents that are in my tribe to really, I want them to build wealth through real estate, and I want them to do so in both residential and commercial sectors. And so I'm hoping that you can kind of give us this like elementary overview of even some of the terms that you've already thrown out. Like what is all of this stuff, and why should I be concerned with it? Could you kind of take us through some of the ABCs of what you do?
Yeah, sure. And candidly, like this fits with a lot of like some of the clients we work with, because a lot of guys that I do work with are coming from the residential space and going to commercial, or for instance, are in the residential space and have just built up their portfolios to the point where they are commercial, right? I mean, literally, I'm telling you, just yesterday, I closed a $3.5 million loan for a guy with a portfolio of nothing but single family homes.
Yeah.
I mean, you just get to a certain size and you're not a residential guy anymore, even if it's just houses you're doing, right?
Even if the asset type is residential.
Right. That's right. And residential, just rental real estate, as you know, it's become huge, but it's become even bigger to the effect where, I'm working on some deals where guys are building, $50 million developments of nothing but build for rent houses. Like they're all on different pads, but they're just for rent. So, generally speaking, the first thing that I tell people when they're coming from the resi space up to the commercial space, or want to start looking at commercial loans versus residential loans, is that like the easiest way to really get around the concept is that it's a different industry. I mean, it really is. Commercial loans are not residential, right? So you have your typical residential loans that are gonna be fixed for like 30 years, right? And super low closing costs and all this stuff. Your typical commercial loan is gonna look like a 5-year fixed rate and a 25-year amortization, right? So, I mean, just getting around the idea that it's not fixed for 30 years and they do balloon, right? And there's different underwriting and the amortizations can be shorter. I mean, that in of itself is a little bit of a learning curve, right? Some of the other stuff where I see guys stepping up from residential commercial is, like the operational side, right? So a lot of residential investors I'll see have a portfolio of somewhere between 2 to 10 houses, right? And they're very comfortable operating those houses themselves and managing themselves. And they say, hey, well, I've got 10 houses. I'm going to buy a 10-unit apartment building. I should be able to manage myself, no problem. That a lot of lenders are not necessarily going to be comfortable with that. The managerial aspect and operations of it is different, right? I mean, it's a business for sure. So going up into that space, I think some guys get a little confused, like, hey, why can't I just operate this myself? Like, well, this is a giant building versus smaller houses, right? So it is different, right? Some of the other areas where, there's definitely going to be differentiations is you can start, once you get in the commercial space, you can start to get into non-recourse lending. So like loans that have no personal guarantees attached to them, stuff like that. Some of the terms and structure gets a little bit more complicated in those. But that's obviously something that's highly attractive to a lot of people moving right into the commercial space.
Definitely. So that's really I want to kind of approach kind of the next couple questions around the investor who is in that space where they've started to scale up their portfolio, perhaps even single family properties. And they're trying to figure out like, okay, I'm running out of conventional residential financing and I'm having trouble. Like, how do I know when it's the right time, Jake, to approach a commercial lender and ask them this question? Should I be bundling all of this stuff together in a commercial product? And I've gotten that question a lot lately with agents who are like, yeah, I have 7 single family homes and a duplex. Should I be thinking about commercial lending or restructuring this debt? Like, what do I do with this? What would you say in a scenario like that?
It's kind of like asking somebody like, should I invest in the stock market? Right? It's like, well, it very, very much so comes down to like what your investment, strategy is and what the plan is for these in the future. For instance, right? So a lot of the guys that have, they've done residential and they've actually done like residential loans for those properties, right? Those are going to be extremely competitive loans for these investments. If you're getting FHA or whatever's available for residential, right, and but at very low rates, no prepayment penalties, all this stuff, those are extremely competitive. You mentioned doing like a portfolio loan, right? Once you portfolio some of these loans, yes, you'll be able to access larger amounts of capital. The loan I did for the guy for the portfolio, that was non-recourse, right? But there are some things that come along with that. For instance, he can't, like there's a prepayment penalty on this thing for 10 years, right? So this guy just did his loan for it. He can't sell off one property out of the portfolio, right? And just pick something out and move it out and move something else in, right? So that portfolio is locked for 10 years. And that's a concept that might be difficult. And it is really a judgment call for, a lot of investors. Like, hey, go ahead.
Sorry to cut you off. Are all portfolio loans like that then? That once the portfolio is packaged together, it's been underwritten and it's actually been lent against, then you can't move things in and out of it? Or have you seen it structured other ways too?
Can't move. Well, so some lenders, right, will have like release provisions, and you can do it, but it can be very costly. Right. There's probably a couple lenders out there that have no prepays and, and might allow it. But the vast majority, especially if you're in a 10-year fixed rate, they're going to have prepayment penalties. And I can tell you 100%, if it's a non-recourse loan, all of them are going to have prepayments, and they're going to be really, really cumbersome prepayments like yield maintenance or fees and stuff like that. But those are, I'm not going to go into those right now. You can look those up, but put it this way: you're not paying it off, right? It's ludicrously expensive to do so. But even if you can pull something out, you can't put something else back in. So if you're the type of investor that kind of cycles through deals and your like life cycle of a property hold is 3 to 5 years, something like that, I would stick with individual property loans. I think this isn't exactly my space, residential lending area, but I think the max residential loans you get through FHA is like 10 or something like that. Yeah. Yep. Then you have to move over to just typical bank loans. And if you're the type of guy that moves on properties, I would continue to do each one individually versus doing the portfolio.
So let's talk a little bit about someone acquiring their first commercial deal and working with a commercial lender. Let's just call it I've identified some type of mixed use space. The bottom is retail, and I have a few, apartments above it. I don't know if I'm getting too specific, but something like that. And I approach you, Jake. Like, what if I only have familiarity with residential lending practices? What am I going to have to be prepared for as an investor in order to qualify for getting capital from you for that deal? What does that
mean? Right. So that's a great lead in to a concept that I very so often talk about with people who are moving from the residential space. And that's the pre-qualification concept, where with most residential lending, right, you go say, hey, I'm going to go get pre-approved for a loan, right? That doesn't exist. There's no commercial loan pre-approval type of thing. It's really, so if you think about residential lending, right, it kind of starts with the person, right? Like, what's your income, what's your credit score, and then you kind of moves down to the property level. With commercial, it's flip-flop, right? Which I personally start with the property itself, and I'm concerned with the economics of the real estate asset that I'm buying. And then that all works. I size my loan off of that. Then I can kind of move on to the sponsor themselves. So for me to even start looking at a deal, I've got to know what the property is. I've got to have rent rolls and P&Ls already. Then I can start doing it, right? And that is, you're not wrong. That is a concept that, it has been a little bit of a hurdle for some people to like understand and approach, because they're like, well, how do we even know, you know what I mean, what I can afford or what I can get? But it's all based on the property economics first.
It's the economics of the deal. You're looking at the math and the likelihood that this deal is going to produce a certain amount of income, right? In order to make the economics work, right? I mean,
that's right.
Okay. So then what, like, in those, which leads me to believe, let me step it back, that for us as investors, one of the things that we have to continue to get better at is being better underwriters ourselves in order to then bring these to you as a lender. Because I have to be able to defend some of the things in this analysis, this pro forma of this property, and defend it as an asset. And so what are some of the things that I should be looking at even in initial underwriting before I go and put this on your table?
That's right. So when you're looking at commercial deals, I would say, let's just take a deal you find in the market, right? It's on LoopNet or whatever, right? And a broker's put the deal out there, and you're an investor looking at it. You need to do your own underwriting, because I'm gonna just throw it out there that not every pro forma works out the exact same way as it's in an offering memorandum, right? Like, I don't know. Like never. I'm just throwing it out there. Yeah. Do your own underwriting, right? Make sure that all the assumptions are correct, right? There's like different commercial assumptions than I think is in typical residential underwriting, right? So when I look at a commercial deal, let's say it's just multifamily, there's things that I'm immediately kind of accounting for: vacancy, market rate management, and that in the management thing, right? Like accounting and underwriting for, let's say 5% vacancy. That's your average for all, residential stuff. But accounting for underwriting for management is another thing that some people kind of have trouble getting over. They're like, well, I'm going to manage myself, so I can add that back in. No, that might go to you, but I still have to underwrite it, right? I mean, I still have to take that income out to end up with my Dscr. So that's another thing. Also, like appropriate levels of CapEx. The biggest variations, candidly, that I see in offering memo pro formas and what it actually ends up being is not the income. The income's easy to tell. It's the expenses, man. Like, go in, verify those expenses yourself. Get the actual utility bills, X, Y, Z. I can tell you from experience. I own 3 apartment buildings here in Chicago. I bought one building. The utility bills were a lot higher than I thought they were. Okay, but everybody has a learning experience. They were a lot higher. So it is what it is. It was still a good acquisition. It worked out, but it doesn't always work out the way that it's presented.
Oh, I'm dealing with that right now with a small duplex in one of my northern climate where oil is friggin' double what I had actually done it. Thankfully, it's still cash flowing, but it's rough.
And it's stuff you don't expect, like water, right? Like, it's a water bill. No, that's a big one. Yeah.
Especially when compounded over 20, 50 units, right?
Exactly. And the thing is, like, that's a great point too, right? Because these expenses are exponential in multifamily properties, right? So like, if you've got, an issue in one thing, right, you're going to have 15 people that are adding to it. So, I mean, like, definitely making sure that you know how to control expenses, but also when you go in, really work on the utilities and make them as efficient as possible, because that's going to cause a lot of big issues for you down the road.
Okay. Yeah. So So this question is a little bit more selfish. So I hope my listeners are okay with that, because smaller multifamily, things like that, I at least have some familiarity with. But I'm going to go back to my example with retail, or even let's go restaurant for a second. Do you do lending on like restaurants and things of that nature? Things that a business has to go in?
Sure, absolutely. I mean, I've been doing this for 14 years, right? I mean, I've done a little bit of everything, a little bit everywhere. Yep. And just being somebody that helps people find financing, I quite often get deals that are hard to finance, like hotels, restaurants, stuff like that. There's two categories of the business real estate asset space, right? There's the owner occupied, and then there's the investment property. Investment being like you own a space and you lease out to the restaurant, right? Owner occupied would be, right, you own the restaurant and you buy the space for your restaurant,
right? And
there's two totally different categories of financing for each of those. Anything that's owner occupied, right? You have access to the SBA and maybe the USDA in certain areas, and those are pretty competitive, high leverage ways to do startups and hotels and stuff like that.
Okay, all right, good point there. And that's for owner occupied. Now for just investor, what does it look like? Again, like I'm looking at a space that a restaurant can go into, because like you said, even coming off the pandemic, there's some opportunity there where owner occupied did have to get out of these spaces. How do I underwrite something like that, Jake?
Yeah. So let's go back to this mixed use example where you got the resi up top and the commercial downstairs, right?
All right, cool.
Commercial different, right? And when I look at a commercial space, especially when it's like, for instance, if you got 4 apartments up top and a commercial space below, I'm guessing that commercial space probably accounts for at least 35% of the income that the property is giving off, right? And that means that it's extremely important who's in there, what's in there, how long they've been in there, and how well they're doing, right? So let's say you were buying this building and that downstairs area was empty, but you're like, you know what, I've got a lease with a new restaurant, and they're going to go in that space afterwards. Candidly, I would not really sure you could underwrite the income that's going in there, right? How many restaurants fail every year? All this stuff, even if it's just a new business, right? I mean, there are exceptions to that. Let's say you were buying that space and you were putting a Subway down there, right? With a guy that owns like 30 Subways and he's personally guaranteeing the lease. Totally different, right? Yep. I'd probably find somebody to underwrite that income. Or let's say you're buying this building and there's been a restaurant down there for 20 years and they'll provide you financials to let you know that they're still doing well, right? So you see where I'm getting at here. Like at a level, I'm not only underwriting the real estate, but I'm also underwriting the business itself, because like it or not, you're very much so tied into the financial well-being of whoever that tenant is down there. When you have commercial space, the more tenants you have, the more you get diversified and the more you kind of diversify that risk. But especially, when you're buying small mixed use commercial and a large majority of that income is coming from commercial, you're very much so tied into their success.
Yeah. So definitely for listeners out there, what Jake is getting at is you're underwriting both the economics in this example of the residential, but also recognizing that a large percentage of the income is coming from that business, and so the financials of that business matter. And so it comes down to being a good investigator and being able to pull and understand financial documents. And so if that's not you, then you need to spend some time getting more expertise in how you read financial documents in the first place. So I know we're a little elementary here, Jake, but I think this is really helpful for my listeners to understand some of these concepts. A few minutes ago, excuse me, all day I've been doing that. A few minutes ago, you threw out really quickly, but I picked up on it. And actually, one of my agents was just in my office talking to me about this, asking me questions about this the other day. So I know there's others that have questions. You threw out Dscr. Can you just explain what that is and why that's an important term in what you do?
Right. So Dscr, debt service coverage ratio, is an acronym for debt service coverage ratio. And it simply means that, let's say I figure out the payments of whatever loan I'm doing, right? And I need a 1.25 Dscr. That 1.25 is probably the most commonly used, debt service coverage ratio out there. It goes up and down depending on what it is. Some multifamily will go down to 120. Simply what that means is I need $1.25 for every dollar of loan payments that I have to make. So I mean, they're saying like, hey, you've got to have at least this much cushion, and then wherever the loan amount that you figure out hits that 1.25, that's going to be your max loan amount.
All right, very cool. Easy enough, and I think that's helpful there. Now, am I mistaken to say that there are now, and maybe you don't know this, but I'll throw it out anyway. Are there residential products that are now largely based just on that DSCR, or is that strictly a commercial?
Absolutely. You mean residential loan products?
Yeah, residential loan products.
It's a good question. It's a little outside my space, but the way that I believe most of these residential loans, like from FHA and all this stuff, are being underwritten is still very much so based on the credit score and financial, capacity of the person, but they also take into account like what the rent payments and average expenses are. So yeah, I mean, they are underwriting, the FHA residential loans. They're underwriting the income properties loans, but it's probably a little bit different than
it's weighted differently than
correct
how you guys deal with it.
I don't underwrite those directly, but I know they are taking into account the income of the property for sure.
Yeah. So let me ask you this. Commercial money. You talked a little bit about how it's structured, 5 years on a 25 amortization, the balloon, what, and this probably is all over the place. And so forgive me for asking questions that you're like, man, I could answer this so many different ways, but, what type of interest rates should one be expecting for, some of for the money these days in the commercial space?
Sure. There's a lot of answers. There's a lot of different loans out there. I would say the vast majority of like 5-year, let's say you're over $1 million loan, right? So there's just kind of an inflection point in commercial lending around like $1 million.
Okay.
There's a lot more sophisticated programs that are available out there for over $1 million. And that's at that $1 million level, that's where your non-recourse lending is really going to start. There is some but it's not readily available. And the vast majority of the lending below $1 million is done by local banks, local and regional banks, stuff like that. Let's say I'm at a $600,000 loan amount. What I would expect, and I'll give people a great tip here. The best place to go for smaller loan amounts, sub $1 million, is to small local banks. Like literally find an easy to work with community bank that's like in close proximity to the property. That's going to be your best guy for that. Okay, so I mean, I've been doing commercial lending for 14 years. I own 3 apartment buildings in Chicago. I literally Googled the address of the property and then banks and found the one branch community bank that's closest to one of these properties. That's the guy I'm going with. That's the easiest way to do it. Good community bank terms are like, for these smaller loan amounts, a 5-year fix, a 25-year AM. They'll probably give you like a 4% something rate today with maybe a 0.5 point closing fee, right? But it'll be very low closing costs, low prepayment penalties, easy to work with. If you go to Wells Fargo, it's going to be a disaster, right? I mean, it's not the space. If you are over $1 million, then you can start getting into some really interesting, more sophisticated finance. That's where, let's say you're sticking to the multifamily space. That's where the agencies that are in the residential space actually come back to the commercial space, right? So I can do a Fannie and a Freddie Mac loan for over $1 million. And let's say I'm buying some apartment building that's like 1.3 million. I can get up to 80% loan to value with 3 years of interest only on a 10-year fixed rate, a 30-year AM, and a rate in the mid 3s probably today. So, wow. I mean, that's your tax dollars hard at work. It's hard to be competitive against that for anybody else, right? So the vast majority of the small balance kind of multifamily money in investment ends up going to Fannie and Freddie multifamily commercial products, right? That those come along with the prepayment penalties and stuff we discussed, right? The property has to be 90% occupied or above. So these are all stabilized, right? And I think a lot of the guys that come from the resi space, what they're used to doing is buying a house, fixing it up, and then renting it out. And a lot of what we do in the commercial space is similar to how they use bridge loans in residential. A lot of guys use small hard money lenders, fix up the property, and then rent it out, right? And they get that great cost basis arbitrage. So you can do that definitely in the commercial space, but you can also expect much better private bridge lending terms. Whereas a lot of the guys I see in the resi space are like 10 and 2, something like a 10% rate and 2% closing fee and stuff like that. Even with small commercial stuff, I would say, you're like maybe 1 point in, 1.5, and like a 7 or 8% rate with very small commercial. If you're doing like a $5 million deal, like it might be like a 4%, rate on your bridge loan. So the higher you go up in loan amount, the more sophisticated and lower cost the products are going to get. And then you start accessing that non-recourse money as well.
So you threw out the number 1 million to 100 million is really where you guys play a lot. Is that,
yep.
Did I hear that right?
Yeah, so that's small to middle market. And I used to say middle market ended at somewhere around 50, but I don't think that's true anymore. So
yeah, it's amazing how fast things accelerate and change.
It was really, I was saying that before the pandemic. Now I'm like, I don't know. I think it's middle market's like $100 million now.
Yeah. So tell me, what's this is an opportunity for you to tell Clopton Capital a little bit. Like, what's your, would you say is your niche? Like, where's your magic where you really differentiate yourselves in this space? Why do I come work with you specifically?
Two reasons. My space and a lot of lending in general today is trying to, in commercial, is trying to be like a guaranteed rate or rocket mortgage, right? I think the residential lending space is very boxy, whereas you have a very defined, set of criteria, and it, kind of gets done, right? Every single property when commercial is different. I mean, even like, a 5-unit is different from one area to another. And, we're not going that direction, right? I'm actually actively going the other direction and making sure that we still have hands on every deal and that like we're personally involved in every deal. Because I'll tell you, man, things always come up. It's like autopilot, right? It works really great till a goose flies into the engine. Then you need somebody there.
Right.
So, I mean, I'm not interested in trying to do as much business as possible without ever actually knowing who I'm doing the business with. Real estate's a relationship business, and we're pushing as heavily towards being non-commoditized as possible. Additionally, we run our business a little bit differently, right? So I don't go out there and just target the same thing over and over. What I tend to do is follow macro trends and what's going on in the economy, and then kind of, like figure out those. Like for instance, during the pandemic, I do a lot of hotels. Hotels weren't really working during the pandemic, shockingly. So
I went to the Ritz and it felt like a Motel 6.
Yeah. So what we did though, what was working was residential development, building houses, stuff like that. So and what I actually ended up doing was pivoting pretty hard into something we hadn't done before and put together a program for residential, construction builders and all that stuff. And we ended up doing a whole bunch of deals and had one of our best years ever. So that's one of the concepts of like, being an intermediary and being able to really understand like where the demand and the, and the supply, demand for product and then supply of capital is going, and kind of pivoting into that.
Well, so let me ask you a question that relates to that then, and that is like, none of us have a crystal ball. But where do you see now, a couple years into or out of the pandemic, however we want to map the timeline of that? Like what's next? Is it still, in your estimation, for you along that residential development? Are you seeing anything in different asset classes that cause you to want to move in that direction? kind of like what do you forecast for the next year or so?
It's a good question. So I tend to follow both sides of it, right? Like, what are the demographic trends that are pushing certain property types, and then kind of where like equity capital flow is going. Meaning, like, on the equity side, like, where are people trying to find yield? Because that's the name of the game, because rates are so low and people are just kind of looking for stuff, right? On the demographic side, I'm extremely bullish on, residential style rental housing. Especially these build for rent communities, right? I mean, just demographically, I think, more people are starting families, getting a little bit older and moving outside cities. And like, the desire, I think, to live in just towered multifamily has kind of diminished also since COVID, right? And people are wanting more space, and that residential rental product fits just so extremely well with that, right? I mean, nobody wants to live in an 800 square foot apartment forever. What goes along hand in hand with residential is self-storage. We do a lot of that. So that's kind of the same concept of self-storage, right? Going back to the sort of crisis things, and then where's the opportunity? I think because of inflation that's going on, and also because we're riding the economic cycle back up, hospitality can and probably will do very well, right? So hotels tend to really come online further down, the upward cycle. But also hotels have a competitive advantage over other property types that, others don't, whereas they can change their rates they charge on their rooms every second, right? So they don't get locked into leases and stuff like that. So they're actually a good flat hedge against inflation. Whereas, like, I'm very, very bullish on industrial, but industrial, just because of everything that's going on, logistical space, but I'm more bullish on building industrial versus investing into industrial long-term, because industrial tends to have very long-term leases with 2% rent bumps. And when you're getting inflation that's 7% a year, your value is getting eroded pretty quickly. Yeah. The inflation thing brings me to another concept that I push people towards, but carefully. And that is being comfortable and recognizing opportunities where you can take on lots of debt. And let me explain that, because that's contrary to what everybody has ever told you your entire life. But if you originated a loan today and you were and you took on as much debt as possible, inflation's 7%, right? Or maybe it's more now. I don't know. Probably going up as we're talking. So, and your interest rate is 3%, but let's say inflation's that, right? In one year from now, not only did you pay negative 4% on your money, but that loan, those loan dollars you owe to the bank are worth 7% less. So, I mean, the equation of value for taking on debt is heavily skewed towards investors right now, right? Now, I wouldn't say take on as much debt as you can in every scenario possible, but if you've got the right scenarios, I would say swap equity for debt whenever I can, because my dollars I have to put in there are worth significantly more than if I were, to me, than putting them in the project if I can take on debt.
I think that's a really interesting concept that, like you said, runs contrary to much of what we hear.
Right. This doesn't apply to credit cards, by the way.
there we go. Yeah. Don't do that with credit. Yeah. But no, I think you're exactly, when you actually look at that and as a representative math problem, it starts to make sense a little bit more. Sure. So Jake, let me ask you this. What have I not asked you that you really were hoping I would?
I don't know, man. How can we do some business? I know we covered a lot of topics here. So, let me know if there's anything else your listeners you think would want to hear.
Well, I think, I appreciate you letting us take a really organic approach today and kind of go all over the place. Sure. Because I think my desire for everyone in my network is just to continue to get more and more familiarized with this world, because especially when you're living in residential, single family, conventional lending, I think it's hard for specifically real estate agents, which make up a large percentage of my audience, to start thinking outside the box. And so they may acquire one or two properties and then they don't know how to scale from there. And I think you, Jake, just taking us through and helping us to think outside the box a little bit is going to be really helpful and impact a lot of people. So what I want to do now is just transition us into the last segment of our show. I call it 3, 2, 1 action. It's the same 3 questions we ask every guest. Are you ready?
All right, I'm ready. Let's do it.
All right. So question number 1, who is the most influential person on your business and why?
This is probably not the answer with me.
Go tell me why.
Man, honestly, well, you heard my backstory. It was my concept. And then, it's really just been, not being afraid to fail, making the phone calls, building a network. And I think with every business, you get to a certain point very early on where you feel like it's not going to work. But then if you can carry on and can get through that hump, it's usually right about then where it's about to start working. You know what I mean? And that's what I got over that. Right. But all the businesses like my friends start and everything, it's what I tell them, like, I'm telling you, right when you feel like it's not going to work, it's about to, because you're at that tipping point where you've made enough, you screwed up enough, right? To the point where now you're going to start making the right decisions.
One of my favorite books is Think and Grow Rich, and there's the analogy in there, the picture, of course, that we've all seen, whether we read the book or not, of the miner who is digging and digging, and he's dug for hundreds of feet, and just on the other edge, with a few inches of soil left, there's the diamond, right? And he turns around and he goes the other way. And, people ask me a lot, Jake, like, well, how do I know that I'm at that point though? And there's not another 100 feet to keep mining. And I love the way you put it. It's when you think it's about to not work, that's probably where the magic's probably on the other side.
Right. I feel like it's that critical mass of like, things not working, but that's what figuring out the business is about. You're going to figure out all the ways it doesn't work. Like you watch CNBC and all I hear about is people making $1 million or $1 billion in like 30 days or something like that. That never happened, right? It takes
you didn't buy crypto apes? Come on.
No, didn't do that. I did finance my first crypto millionaire a couple months ago though. So
did you?
Yeah,
that's interesting. I kind of want to hear that story.
Well, I was like, you got to pay taxes on this stuff, right? So that was a big. It was just interesting to see that actually come to fruition, actually happen, and see it in real life. So
yeah, that's pretty neat. So since we're on the topic, and I drug you right into the topic of commercial debt really fast. What was maybe a time in your business where you felt like you were, maybe just hitting your head against the wall and we're going to fail, and you were able to just like push through that and take the business to the next level?
Yeah. Well, when I started, it was a hard time, right? To get going and stuff, because like you'd make calls, you're like, I'm not lending, you know what I mean? It was just keeping going. Also at the same time, I had just had my first son, and I was like, oh man, this better work. So, the pressure was definitely on. So I mean, by far and above, it was the first year and a half of really doing it, right? After like somewhere between 12 to 14, 16 months, somewhere in there, I closed at a $14 million loan, and that's when I was like, okay, this can actually work and go somewhere.
I can do this.
I don't have to go try to trade, something again. So, awesome. that was when I first started feeling really good. But, I had a lot of pressure, man, but I kind of did the Columbus thing where I burned the ships and couldn't look back. So
yeah, definitely. And that tends to usually be a theme with our guests, where success is on the other side of that. When you're willing to burn the ships and push the chips all in, so to speak.
Yep.
And that's why we love interviewing people like you. So I'm going to go to question number 2, which is, what's the most influential book on your business and why?
So as far as like reading goes, the most influential thing that I do is not necessarily reading books, but I read an enormous amount of articles every day. Like I have an RSS feed of probably 30 different news outlets that I make sure that I read through every single day to make sure that I stay on top of what's going on. And this goes into the concept of how we run the business of like pivoting into trends and trying to stay ahead of things before they happen, right? Because I don't want to be beating my head against the wall against something that's not working. I want to be the first guy that like I see, a pandemic happens and I see residential housing's working. I want to get ahead of that, start marketing it, and find out how to make opportunity off of that. So for me, it's not necessarily reading a book. It's reading an enormous amount of news and absorbing all of that really every day. So, yeah. I mean, I would say that.
I love that. I love that answer, and it makes a lot of sense. And I'm curious, similar to just, investing in finances, I imagine that there's like a little bit of a diversification in those news outlets so that you get a full perspective. What are maybe just a couple of those resources that you tap into that maybe aren't as well known, that maybe our listeners could as well?
There's one that I really like, a website called Wealth Management RE, WMRE puts out, and they actually do like a 10 reads of the day for commercial real estate. Okay. And they aggregate it from like other places. So you get a little leverage on leverage there. So that's a great resource for people, just to hit like the big articles of the day. And the stuff that's really boring in real estate is like seeing some like article about a $90 million deal that goes off in New York City. I don't care about that, right? I mean, I care about like the overall trends and what people are following and, like stuff like that, like stuff that's really meaningful to places outside of like New York and maybe some areas of California. And like if it's like an article about Florida or somewhere where there's like, I know there's real big demographic stuff going on, that's really interesting to me.
Yeah, very, very cool. And then just one more question on this is sure. How do you tabulate that data as you're taking so much information in? Are you sometimes, because I take in a ton of information as well, and sometimes I don't necessarily capture that to go back and synthesize it well. Yep. Are you a note taker? Are you just a genius and keep it all in your head and then can be like, okay, here's the trend that I'm sensing? Like, how are you tabulating that? I'm just curious.
I'm going to go with genius. No, I'm just kidding.
Yeah, I love it. You are.
No, I have probably a different trick that I think it's a little bit backwards. What I do is I focus on what not to remember, right?
Okay.
I'm like, I don't need to know that. I don't need to know that. I need to know. Oh, here's the important. In anything you read, really, there's probably only a couple lines in there that are gonna stick with you and get the concept across, especially in like an article, Right. So there's like a couple general concepts in there, and for me, just like making sure I don't pay attention to the unimportant stuff and absorb quickly what is important in there. I can get through it quickly and take home what I needed to out of it. And that's how I've kind of approached that's how I approach like college too. I'm like, this is important. They're just figuring out like what's not important, what not to work on, what not to spend your time on. That's going to make you so much more efficient at everything. Not just reading real estate articles.
100%. Eat the meat, spit out the bones, get on with life.
Yeah.
Question number 3. As you know, this is the All In podcast where we encourage our listeners to take immediate and massive action to move their lives and business forward. And so on the topic of today, breaking into a commercial deal, what's the first thing that our listeners should go out and do in order to get into their first commercial deal?
Figure out where they want to invest, right? Like, what are the areas? Don't go on LoopNet and search for 8% cap rates and then find out you want to do a deal in Idaho. Figure out the area that where you want to invest. And then my advice is to reach out to a property management company in that area and start interviewing property management companies and asking them for 2 reasons. One, they have by a wide margin the most detailed and on the boots ground information of what's going on wherever you want to invest. They manage the properties in those areas. They know them. They can help guide you. Also, you should use a property management company if it's your first deal. 100%. Don't manage it yourself. Get a property management company, at least for the first year. Second reason to reach out to property management companies, a lot of times they have stuff that buildings they're managing they want to sell and it's not on the market. And those can be great opportunities to get in, not only to use them who's already managing it, but they have all the information, and then maybe it's an off-market deal that's not on LoopNet that's super competitive. So that's my best advice to start out. Go figure out the operational side first before you try to go commit to some deal, and get the boots on the ground, reach out, start making those connections.
Awesome. Thank you so much. Jake, you've given tons of great information. I know that people want to find out more information about Clopton Capital and you and any other content you put out. Where can our listeners connect with you?
So I'm all over LinkedIn. Feel free to hit me up on there. Or our website is cloptoncapital.com. This is all I do. I'm always around, so I'm happy to chat about deals.
Awesome. Well, thank you so much for investing some time with our crew. I'm glad we got connected, and I look forward to interacting and, as you said, hopefully doing some business in the future. And so I really appreciate our time together. Have an awesome day, man.
Likewise. Appreciate it.
All right. Thanks so much. And guys, hey, I hope you've enjoyed this episode. I hope you've learned a lot. Definitely hit up Jake on his website. And as always, go play all in.
Hey guys, thanks for listening to this episode of the All In Podcast. We want to invite you to find all of today's resources from our show page at aipodcast.co. We also ask that you take just 1 minute to leave us a review on iTunes or wherever you get your podcast. This is how we grow and how we're able to bring you the best content each and every week. Now go play all in.